Broadcast is now starting. All attendees are in listen-only mode.
Hi, everybody. This is Patrick Zielbauer from Infinity. You're in the right place here. We're going to get started in 2 minutes at 3:30 Central. So hang tight. We'll be with you here in just a bit. Thank you. Hi, everybody. This is Patrick Zielbauer from Infinity Futures. Welcome. It is 3:30 on Thursday, August 9th. Thanks, everybody, for coming to the event today. We certainly appreciate your attendance. Today, we have Martin Rhymes from Hit the Mark Trading in with us today. And what I would like to do is go through a little risk disclaimer and then a quick introduction, and then we'll hand it over to Martin. He's got a great presentation planned for us, and then I'll kind of be hanging in the background answering questions more related to brokerage and the like, okay? So let's go ahead and read some risk stuff first. Trading futures, options on futures, and retail off-exchange foreign currency transactions, that means Forex, involves substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. So folks, only fund your futures account with risk capital. That means money you can afford to risk without lengthening your retirement horizon or affecting your ability to maintain your lifestyle, okay? If you're unsure where you fall on the risk capital curve, so to speak, please don't hesitate to have a discussion with your rep in our office. Everybody here has one, whether you're a client or a prospective client or whoever you are. We are certainly happy to discuss with you risk in an objective manner, okay? It's not something we sugarcoat, so please don't be hesitant to have that discussion. So Martin has not done a presentation with us in a while. We're really glad to have him back. I would like to sort of preface things on a slightly more personal level based on my interactions with my own clients about why we like to bring Martin in from time to time to do events with us. Martin and I were connected several years ago. He is a client of Infinity, trades a futures account here with us. And basically, one of the things I have found, and you've probably heard me say this in some of the webinars we do about Sierra or the videos on YouTube, one thing we're finding in this business is that things are getting crazy complicated. People are looking at tons and tons of studies. There's hundreds of indicators on the chart. There's 20 different markets and 30 different time frames and all kinds of granular data, and it's just really getting, I think from time to time, it's good to just have a hard reset. And that's oftentimes where Martin comes into play. So Martin uses I'm going to let him go into the details, but he uses some pretty basic stuff, really centered around the CCI, which is an oscillator that I happen to look at myself, on a daily basis, and some trend lines. And it's just really, really simple. If you feel like you've been in a position where things have gotten just insanely complicated and you can't put it all together, and you think maybe a good reset before Labor Day and the fall starts and the volatility comes back and so on, it would be good for you, then this is, you're probably in the right place, because this is an opportunity to do that. All right. A couple things I want to highlight that really have to do with Martin and this and what he's doing with his service. The first thing is, everybody should go to his website, hitthemarktrading.com, click on free stuff, and put your email in here and get 30 days of the Rooster Call. Okay. The Rooster Call, I'm on this list. I've been on it forever and ever. It looks like this. It's an email that I get in the morning, and it talks about like what happened at night. It's written by Martin. You can tell it takes time to write this thing. This is not just a couple of bullet points. And it's basically talking about what Martin, saw overnight, and it's very easy to follow. It's very, very well written. The copy is very, very good. He's a very good writer. And, it's got some quotes and some things that are relevant that you might see, if you're reading the Financial Times and that sort of thing. And then it talks about all the economic points that are happening, and just a little bit of a quick summary of all the products, and their movement overnight. So this is a really, really cool thing to read in the morning. Martin injects just enough of his own, insight in here for it to be interesting. It's not just a repeat of something you read on Market Watch or something like that. It's very, very well written. So if you're looking for something to read in the morning, this is a really cool way to get exposed to what Martin is doing and how he's looking at things fundamentally and technically. So I'm a big fan of the Rooster Call. I read it every morning. It's cool. Everybody should register for it. Okay. Secondly, and I'm sure Martin will mention this as well, but if you are in a spot where you feel like you do want to do one of these little hard resets, Martin's teaching a class next Thursday. I've gotten really good feedback from a couple of my longest running customers about Martin's classes. He's doing one. It's called Just Day Trade, Tuesday through Thursday next week. I have a couple of clients who kind of act as sort of a litmus test for me of whether or not, this particular educator has a class or a course or something that's worth taking. There's a couple of people that I've got in the books who I can think of right now who have been through Martin's class, who had already been through, the ringer, so to speak, with everything else they've done and really, really gotten a lot out of it. So I highly recommend you explore this, especially if you're finding yourself in a position where you really just like to have a hard reset here before Labor Day. So definitely encourage you to explore, his services. The Rooster Call is like it's this free item here. Just go to hitthemarktrading.com, click on free stuff, and put your email in here. You'll start getting that the next day. And again, it's a great way to get started. So we want to say thank you to Martin for being here today. Thanks everybody for coming to the webinar and listening today. If there are any questions related to Infinity or brokerage or margins or those sorts of things, please feel free to put it all in the question box. I'll be here. We'll go through it till about 4:30 Central, 5:30 Eastern. Should give us plenty of time. All right. Okay. Well, thank you again for listening. I appreciate everybody being here today. My name is Patrick. Please let me know if I can help you in any way. With that, Martin, I'm going to go ahead and mute myself. And if you want to take the mic, I'm going to flip the screen over to you.
Unmuted.
Okay, Patrick, let's test. Can you hear me? Just want to confirm that.
Yeah, the audio is good.
Okay, and you're seeing, okay, my screen, good. Let's see here.
Okay, now we got the PowerPoint. So yeah, we're good. Oh, that was there a minute ago.
Okay, wonderful, wonderful. Let me get this thing
Yep,
going.
there we go.
Okay, well, hey, thank you, Patrick, for that wonderful introduction. I really appreciate it. And I was really happy when you asked me to speak. I was concerned maybe people might be on vacation in August, but you know what? A lot of people use August as a time to refocus their efforts. They know what they're going against in August, and that's what I kind of wanted to share today. August can be pretty tough, so we're going to talk about that. And then we're going to get into trend and momentum trading. So thank you again, Patrick. I certainly appreciate the opportunity and appreciate working with you. One thing about Infinity is it's full service brokerage, but yet you get the discount brokerage rates, and I like that. Patrick went through my background pretty well. I've been doing this for a while. I started the mentoring coaching in 2008. basically because I was just bored and by myself and all that and wanted to talk trading. I like to talk trading. This is me. And I found that the more I got into it, the more people needed some help. This is my trading room. This is where I'm talking to you from right now in sunny Southwest Florida. I do a couple things other than the rooster call. I also do a nightly market update. And a lot of times, I know everyone here is basically interested in day trading, but a lot of times for position trades, I'll be saying that we're going to start this as a day trade, and as price proves our thesis and we reach a certain level, then we're going to hold this overnight. Okay, so we've been doing that lately. I did it with wheat, we're in euro right now, short, and some other items. So it's fun. It really is. So I call the trades, and you watch them unfold, and I hope you're practicing and learning to become your own guru. Everything that we do, we take a look at the charts with an all-encompassing point of view, price action, price oscillator, and linkage between markets, which I think is very important. Patrick mentioned the 30-day rooster call. It's free. No credit card required. Just let you get to know me. And then briefly, one little mention, I will have a total intensive immersion for day trading starting next week. That's Tuesday, Wednesday, and Thursday from 12 noon to 2 p.m. Now, it's 6+ hours of instruction because when I'm talking with traders, I do not look at the clock. Okay, so it's at least 6 hours. We're going to be focusing on trend and momentum. I'm going to tell you something today, cost you nothing, which is going to immediately help your trading. Okay, so that's just gives you a taste of what we do. And as Patrick mentioned, it's very visual, very, very simplified. But we go through using a momentum indicator. Some things we just look at price action. We look at our protective stop placement. I'm going to share that with you today. Trailing stops and exit considerations. You know, I've been doing this so long that I don't think entries are difficult at all. I think that entries are a dime a dozen. I believe the most important and the hardest part of trading is finding an exit that you're truly satisfied with. Exits are the challenge, and that's because we have so many demons in our mind. Either we're too aggressive or we're not aggressive enough, and you really should work on your exits, I think. So August can be totally, absolutely dreadful. And I'm talking about trading equity index futures. So many people, they say, gosh, I'm going to get into trading, and they work hard and they study and they take no real trades, and they're starting in the springtime, and they're testing, and then they testing in June and July, and they say, okay, I think I'm ready. And August 1st is going to be my date. And then they just get absolutely slammed and thrown against the wall and just totally gutted and left for dead. It's just, for equity index futures, it is typically the absolute worst month for trading. Now, if there is a time to stand aside, this is the month more often than not. I'm not saying you leave trading. I'm just saying that you think twice about equity index futures, okay? Why do we see this phenomenon typically every year? It's easy. The Europeans take a month for vacation, you know? That's it. That's a lot of volume gone. USA is in full vacation mode. We start ours earlier. The volume simply dries up. That's it. And what movement we see typically is very, very slow. And now you know exactly what I'm talking about. Very, very slow. And when you come off of a market like we've had since January, and it's just been so incredibly wonderful with follow-through action, and then you come into a slow move where maybe you're going to move 5 ticks in 30 minutes, right? You've got to be prepared to adjust your mind or find something that is moving. So the danger is your mind when markets are not moving. You know, you make these mistakes of aggression. You just say, okay, I know this is going to work. You get in and nothing happens. You just get bogged down. I don't know how well you can see this. I put a monthly chart together just to show you what the arrows, the month of August. And to an extent, the Federal Reserve quantitative easing, it disrupted August a little bit because the Fed would hold a meeting in Wyoming every August, and if the market started coming down, Ben Bernanke would talk up quantitative easing, or he would announce it. They did it like 3 times, and that always saved the market. In 2015, we had a surprise Chinese devaluation, which caused for a big drop. But beyond that, very, very, very slow. Now I go to a weekly chart, and this shows you a little more clearly. I hope you can see this. Let me get my pointer here, if I can find my bouncing ball. Hello. $4,000 range, okay, for the whole month. And that's from the high to the low. $5,000 range, okay. 2,650, okay. 2,500, okay. Looks like about 3,600 here. And now we've got about 3,600 so far in 2018. Look at this. I've got a seasonal chart at the bottom. And you see where it's predicted we're going to go down, right? We're going to go down. Well, when you see if it did not go down in earlier time frames, that's due to the Fed. That's just absolutely, but they're not doing that anymore. So we see that the normal tendency to go quiet, sideways, to down, it's just wired into the market. And this is all due to one thing: vacations, vacations. But there are some people that are still trading. Well, before I do that, this is August of 2016. So the question I have to you is, how are you going to trade this? Now, this is a daily chart. How are you going to trade this? And it's easy to say, well, I'm just going to, I'll buy at the bottom, I'll sell at the top. Yeah. And remember, some of this action happened in the overnight session, right? So by the time you're there to trade, nothing. Incremental. Or, like we saw yesterday and today, the big boys, when the retail traders are gone at 3:45, the big boys make a move, right? Because they are always going to make money. So they did that yesterday and today. And I believe in following what the herd is doing. So this is a daily chart. So I'm just telling you, this is August. It is tough. I don't need to pull up the Russell 2000. I don't need to pull up the NQ. I don't need to put up the YM, because the boss is the ES. Absolutely. It is the anchor for the equity index futures. So the challenge is we must find other instruments known to move. What about gold? Hello. Let's look at gold. Now, here is a range. Number one, the seasonal says we should be rising in August, and by golly, boom, there's a $16,000 move in 2013. Sweet. Here's a move, $5,000. Nice, 2014. $9,000 move here in 2015. $5,300 here in 2016. $7,740 for the month of August here in 2017. And right now, because of the rising dollar, it looks as if there's a little bit of hesitation to do anything. Which reminds me, in trading, nothing is 100%. Everything that we do in trading, we understand it's more often than not. There is no exact science here. But what we do is we observe and we infer and we see stuff happen over and over and over again. So my gosh, am I looking at things like this right here, right? Are we going up? Well, it says we're going up. Are we going up? Well, it says we're going up. Are we going up? Well, it says we're going up. Are we going up? Well, it says we're going up. Are we going up? Well, it says we're going up. Okay? My point is, we can certainly find things that are moving. I've got another example for you now. Let me see if I can erase this. Good. Here's the crude market. Well, back before that big crude price fall, a normal year, get my pointer, 10 grand in August. Hello. Over here, 3,500. Over here, 2015, 9,700. Hello. Over here, 9,000, almost 9,500 here. Over here, 5 grand. Over here, so far this month, $4,000. That's the range in August. My point is, if we find markets that typically move when equity index futures do not, then we know our strategy is good. In fact, your strategy, you should have so much confidence in it that you can take the name off of any chart and your strategy still works just as fine. If you're wanting to know what these yellow lines are, this is something I do on my own. They mean something. They mean a lot, quite honestly. Okay, so let's go to, you must find moving markets. And your trading strategy should be robust, that it works on any instrument. Your strategy works on any time frame. And what you find is that we can build a quiet confidence, knowing all we require is trend and momentum. Now, day trading is the most difficult of all trading. And you are better served, I believe, working as a visual trader using simple methods. Trust me, the professionals are not using all of these complicated tools out of thousands of indicators. They are doing very, very simple steps. And the reason for that, it's never explained. The reason that the professionals are so simple is because we're talking about a herd of people trying to do the same thing and watching each other, and they all are working on such a simple method taken directly from the days of floor trading. And this is why we see the markets move in coherence and in uniformity. Okay, I absolutely believe there's rules to the game. Just like there's a rule when you get in the car to drive down the street, there's a stop sign, you respect it. There's a traffic light, you know what to do. The professionals do the same thing. And the reason they all do the same thing the same way is because there is too much money involved, too much. So what I try to do is talk about momentum, spotting a market ready to move, selecting a trade, entering the trade with confidence, and utilizing predetermined exit points. Momentum builds off of a firm understanding of support and resistance, along with areas price is known toward moving. That's so important. Why? Because everything repeats. It's repetition. So we're talking about trading directionally up or down, riding the price wave rather than reacting to what might happen, usually accompanied by a price oscillator. I'll talk about one. And you use the same method for intraday or short-term trading, whether you're holding over a day trade, or you're going to hold a few days or a few weeks. Today we're going to talk about day trading. Now the intraday is going to use a daily chart for the big picture, use a short-term chart for tactical entries. As a very general rule, the more volatile the market, the smaller the time frame. In a slow moving market, this is about the only time I will look at a 5-minute chart, or maybe even a 15-minute, just to see, is anybody breathing, Markets move in 3 directions, up, down, and sideways. If the market is sideways, we are greatly challenged unless the range is large. It is imperative to find moving markets. So once again, the reason you're here, I'm telling you, equity index futures traders must expand your horizon at times and look for other futures that are showing movement. It's easy to identify the trend. You bracket price with trend lines, daily chart and intraday chart, and just understand a very complex point here, a very complex concept. Price is going to bang back and forth between the price trend lines. Now, you think I'm kidding you. There's that chart that I showed you earlier. That's a daily chart. Let me go into here's daily crude. What a difference. Let's look at August. This is August. Wait. How's that for movement? Think you can make a living doing that? Well, this is September, okay. Isn't that nice? Isn't that sweet? That certainly beats this. Daily ES. My gosh. Don't wake the baby. Okay. Get rid of that. Now, this is the daily chart of crude. Simple. Just what have we done here when we do the lines? We mark the highway where price is moving. It's not a science, it's an art, drawing trend lines. So and I know big time it's going to be a chart event if we break below this. This is a big deal. Okay? Don't worry, I'll talk about the indicator later. But you can see that if we can just get the big trend in our mind, and then when we day trade and we know what typically where the big trend is going, it will help give you that quiet confidence that if the market is looking long and you take a trade that is in the upward direction, you're probably going to do pretty well. Now this is how a person could draw lines on the intraday chart. Now this is a 10 range bar. So there's different lines here just to reinforce that it's an art, not a science. Someone who woke up early would be drawing this line and the green line. If you woke up later or you didn't want to trade till later, then you probably wrote the blue line. So no right or wrong way to draw it. It's the same general gist. Okay? One moment. Erase. So we're just going to go with this one right here. The one thing I like about the Sierra charts is I do like the easy way they can tell you where the high of the day and the low of the day is. I like that a lot. So let's talk about support and resistance. It's huge in momentum trading. We're going to learn where price wants to touch over and over again. And when we use an oscillator, we have to take the time to notice how price moves, because oscillators derive their power from price movement. All right. If you're on a desert island and you got your choice, do you want an oscillator or just trend lines and price? It's be hard for me to give up those trend lines and all the other support resistance tools that we use, which there are more. Most people, when they're trying to figure out what oscillator to use, reminds me of the story about those 6 blind men in India. All of them feeling a different part of the elephant, and they all describe something different. Well, you got traders, and they say, well, this guy in the front, MACD, this definitely MACD. This guy says, oh, RSI describes the market. RSI is the best. This one percent R. This one Bollinger Bands, right? This guy says, no, I have the better feel for the market with my expensive proprietary indicator. The guy back here says, well, it feels to me like slow stochastics. Okay. And let me tell you something that you're not going to hear. Okay. In a slow moving market, all these indicators are going to have problems. They really do. In the beginning, I used for position trading all of the old war horses: stochastics, MACD, Williams percent R, and RSI. I use Bollinger Bands. Why not? Because it's after the market closed. You are sitting there doing your analysis, and the more the merrier. Now I only use Commodity Channel Index, a CCI, and in day trading especially, you simply do not have the time to wait for multiple indicators to tell you the same thing. Okay? I'm going to tell you right now what you should know. In a strong momentum market, all price oscillators work, and I mean everything. And you want to do a moving average cross, boom, you pick the numbers. I guarantee it's going to work. In a tight range market, all price oscillators will lose their predictive value, all of them. So anyone trying to sell you an expensive proprietary indicator, tell them to show you what August looked like. Bottom line, find moving markets. Now, Commodity Channel Index was created by Donald Lambert. I met Mr. Lambert. In a moving market, the CCI is shown to lead price. Don't take my word for it. Check out John Murphy's take in his book, Technical Analysis of the Financial Markets. This is required reading for people that want to become a chartered market technician. So he talks about a lot of different indicators and spends maybe half a page on CCI, not much. But here's what I want you to notice. Here's the line. Notice that the CCI turns before prices at each top and bottom. Hello. Wow. Well, let's look at this. So the CCI turns. What happens to price? It turns. Okay. CCI turns up, price goes up. CCI turns up, price goes up. CCI turns up, price goes up. Now, what gets you in early can also signal you maybe to get out early. So I do use a filter and nuances, but that's beyond the scope of this discussion today. But you have a great idea of the power of this thing just in this little description right here, okay? All you need to know is that we're comparing price with a simple moving average over a selected time span. Mr. Lambert suggested a 20-day period, and for day trading, we're going to back that down to 14. Don't worry about how to calculate this. And I know doctors and engineering types want to know how to calculate it. I'll give you the calculation. If I look at this too long, my eyes will start glazing over. I believe what you should know is that you're a visual trader and your responsibility is to react. So it's a visual thing. The CCI is plotted on a histogram. I'm going to show you that we have a 0 line, a 100 line, and a 150 line. We have a minus 150 and a minus 100 as well. The 0 line is major support and resistance. And the 100 and 150 are minor support and resistance. Okay? Remember, for day trading, we're going to adjust the default from 20 to 14. Okay? Now, here we go. See if I can... Here's the zero line. Now listen to me carefully here. Here's the 100 line. Here's the minus 100. Here's 150, minus 150. 200 just marks extremes, and minus 200. That's all it is. It just marks extremes. We rarely get into these extreme readings. So, if the zero line is major support and resistance, then when we are above the zero line, we have an upward bias toward price. When we are below the zero line, we have a lower bias toward price. If we see that CCI breaks through minus 100, we are gaining downward momentum. If we see the CCI break through minus 150, we are gaining downward momentum. And the same thing on the upside. If we see it go above 100, that's a statement. Hello, I'm gaining momentum. I crossed through the barrier. And 150. Now, this template here, Patrick created this for me. And I certainly let the clients have this, and I don't charge for it to my clients of my courses. So it's just really a wonderful tool. It's a visual tool. Now, I'm going to teach you something here that is so unbelievably simple that you're going to probably laugh it off, and you're probably going to say, really? Yeah, it can't be. I've heard it all. And then people start testing it, and then they write me, I can't believe this is working. So we're going to talk about the diagonal trendline break on the CCI. Very powerful. You know, I lived in Asia for about 5 years, and everybody there says the word auspicious. It means, you know, very incredible, wow, enlightening. My rule is you draw it from the plus or minus 150 line on the CCI histogram, and you wait for the CCI to break through it. It's that easy. So here we have and I'll show you today's trading later, but right now this is a good chart. This is crude. By the way, we always expect to move at the 7 a.m. ET, the 9 a.m. ET, and the 2 p.m. ET. We always expect to move in crude during those times for the day traders. And of course, you get up early and, you know, maybe you catch a move where something happened in Europe, or something happened with, I don't know, something in the Middle East, whatever, got the market moving. Maybe there's a big European economic report come out and they think, okay, that means more fuel is going to be used. Well, okay, did you get a signal? Take the signal. This one happened around 5:30 in the morning. Here's where we draw our diagonal trend line from plus 150 or higher down. We break it and boom, we go up. And price goes up. Here's another one. I draw it from 150 or higher, so I start drawing it here. I like to touch it. If I can touch it, I like that. It's like the CCI comes up and just fails to go higher and drops. So I mark where we touch it and extend it, just extend it down, and then here we go. We break that and up we go, right? and over and over and over and over and over. So even though I teach different patterns on the CCI and 3 that we don't even use an indicator, I have some people that all they do is diagonal trend line break, and they're extremely happy. Okay, this is today's action. Let's just take a look. A little bit of yesterday's action too. So yesterday we had the crude report, and let's see here. I'm just showing you first how to draw the line. And I want to stress, because I know there's people that always ask this question. They say, I'm not sure how to draw that line. I can touch here. So I'm going to start at 150 or lower. I graze where we touched here and just extend it out. We break it, and that's a sell signal. Over here, it looks like there's really no touch. It's like just a straight shot up. That's fine. Run it along the side. Run it along the side. The most critical aspect is, are you drawing it from 150 or minus 150? Now, some people say, well, why can't I draw it from the 100 line? And I'm going to just tell you that in my testing, I find greater follow through if we can start it at least 150 or minus 150, okay? Now let's put the vertical lines on this chart. There we go. And people will say to me, gosh, I wanted to get into a move today, but the market had already run. I wish I knew how to get in when the market's already moving. Well, the answer to that is look for your diagonal trend line break. So here we got the first one here. Now this is yesterday. Keep in mind yesterday. And so, and I'll show you the protective stop. Don't worry about that. I'll do that. We go short on the diagonal trend line break. And now either profits are taken or you're holding one for a longer term. Everybody's got their own issues with holding runners. Another signal comes up, right? There you go. I want you to understand I'm not looking at volume. And the last thing I want to do is look at the dome and try to figure out the orders when I know, when it's documented and it's proven that those are fake and that this is called order spoofing. And the Commodity Futures Trading Commission complains they do not have the tools to stop it. So I want to see price. I want the price bar to print. And that's going to tell me everything I need to know. All right, diagonal trend line break here. Okay, good. In fact, this one might have been, if you didn't take the early trade, you just got in here. My stop would have been here. And I'll talk to you about that. It would have been hard, I know, seeing this go down and then come back against you. Or if you did this trade, it probably was a loser. So let's just understand you will have losers. Absolutely. Against the losers, you're going to have a pretty high win rate if you take the time and make this yours, okay? All right, another diagonal trend line break, okay? Down we go. I'll just tell you the protective stop now. I put it just above the previous price bar or the trigger bar, whoever is higher. That's all. How simple is that? Now, since I'm using a 10 range bar and each bar is $100, I'm prepared to have a stop of $200, $220. Okay? I don't think anyone can possibly trade crude with a 6-tick stop. I just don't think it can be done. If you can do it, then I'm going to tip my hat to you. I just don't think it can be done. It's too, crude. You got to have a plan when you trade crude, okay? So here's a signal here. Stop. Who's higher? The previous bar. Okay, that's where the stop goes. And I tell people, you've got to absolutely fall in love with this. You've got to test it over and over and over, the protective stop. And you've got to have, like, an emotional relationship because you simply will not believe it until you do it. And if you can test it to the point where you're not going to become afraid and you see price go against you, and yet you're holding on because you know that, let's just throw some numbers out there. Let's say your testing showed 80% of the time it doesn't get stopped out, or maybe it's higher. Why not hold? We know nothing's 100%. This is absolutely the best thing I've ever found for initial protective stop. You can always move it, you can always trail it, but initial protective stop, it is absolutely the best thing I've ever found. Absolutely. All right, so on and on and on and on it goes. Diagonal trend line break. Hello. Now this is in the morning, so Asians are moving the market, and Europeans later. Let me bump over here. When you get this, even if you get a signal, I like to say we do not expect to have more than 2 losing trades in a row. How's that? That's pretty good. And the reason is, if we have 2 losing trades in a row, then either something is wrong with us, our mind, we're distracted, we're upset about something or something, or the market, there's something not right with the market. So when you go sideways, you've got to have no-go rules, and you got to honor those no-go rules. And if it says I'm not going to trade, if the sideway range is $200, $225, something like that, I mean, forget it. Because by the time you get in, they are going to turn the market. You're going to get signals, absolutely. And they're going to turn the market as soon as you get in. As soon as you get in. I know it, you know it, we've all been there. So you need to just stop, box it up, and you must let price resolve this. Okay? You have to. Or you're just going to just feed into the machine. That's all you're going to do. Okay? So each of these bars is, remember, a range of $100 here. So it's just, it's too difficult. There's no other way to explain it. It's just too difficult. Find something else. Turn the computer off. There will be better days. All right. This is what's this move right here? Diagonal trend line break, at least. Okay, well that was a nice move. Diagonal trend line break says go long. Well, that made some money. Okay. This one said go short. Okay, well, went short, but by God, it came up on you. Your stop, of course, would have been a little bit higher, so you're not stopped out. Important to know. But then when you see it sideways, you got to understand, nothing is going to work. Granted, some people want to do 2-3 tick scalping. Okay, ping pong. Play ping pong with it because it's not moving. You see the barriers. And I knew a mathematician that did this trading. It's called regression analysis trading. And, you simply set the barriers up, and at the top you sell, and at the bottom you buy, and you take very, very, very small profits with large contract amount. And he did quite well, a PhD guy. Okay, good. I can't do that. I cannot do that. I pull my hair out trying to do that. So you forget it. You let price resolve the issue. All right, let's go on. So there's other patterns, but 50% of the trades are accomplished with the diagonal trend line break. Okay? This is a gift for you today. You can immediately start testing. And yes, there's 3 non-CCI trades that I use. And it's all to do with following trend and momentum, with the herd controlling the market, and filters we use to basically show us visually that we're on the right track. I want you to remember to draw your diagonal trend lines starting at 150 to minus 150. Better trades in markets showing momentum. We're going to use the 14-period CCI for intraday use, below 60 minutes. And here's the question. If you can't draw a diagonal trend line, should you take the trade? That right there is one thing to ask. Or are you going to be looking at the dome and saying, well, gosh, look at all those orders up there. Wow. No. So we have some entry rules. I'm harping on this a lot. Draw it from plus or minus 150. Initially start with the trend, get used to it. If you want to use a confirmation price bar, if you're using a small time frame chart, you can do that. Unless your trend is super strong, and we do measure it. If it's super strong, you want to just get in. Counter trend only after you've mastered trend trading. There is a reason they say the trend is your friend, okay? The protective stop. If you're going to go long, place your stop below either the trigger bar, the bar that gave you the signal, or the bar prior to the trigger, whoever is lower. That is initial. You're saying, gosh, I don't want to risk, I don't want to risk that. How do you spell initial? I don't want to risk that. I think that's too much money. Well, you just go back and test it, and then you say, well, my God, how can I afford not to do this? Short. Same thing, just flip it over. Place your stop above the trigger price bar or the prior bar to the trigger, whoever is higher. You do that, and I've changed the whole face of your trading for the better. So, briefly, here's the trigger bar. It looks like it's higher. That's where the stop goes. And okay, be exact, Rhymes. Well, okay, a few ticks. 2-3 ticks. Here's the trigger. Stop goes here. Here's the trigger. Stop goes here. About 3 ticks. And if you're worried, wow, 3 ticks. Gosh, that's $30 more. You just test it, please. Okay, here's one. This one is probably a loser. About the only loser I see. But hey, nothing's 100%. And I'm just saying because you probably couldn't get out fast enough, okay? Or you had the bracket order there, maybe 3 ticks, and boom, he took you out. That's life. All right, this one says go short. I guess the stop was here. You survived that little pullback. Absolutely. And price goes down. That's beautiful. Now, that's around 10:30. Of course, we're not going to be, I don't ever trade through the crude report. I wait. Let the crude report happen, and I like 4 minutes, sometimes 3, but I just, it can knee jerk around. So I let it go through the machinations. Okay. We have something we would have done to take advantage of this counter trend, but I don't have time to talk about that today. Here's diagonal trend line break. But here's a little nuance for you. If I can't make it to 100, I really don't have the strength to go higher, do I? Chances are I want to go short if I can. Well, boom, there's your diagonal trend line break. All right. We made a new low of the day and then based a little bit. This had to be frustrating. Red, green, green, red, green. You know how that goes. So what are you doing? How are you gonna fight that? It is a battle. You're gonna box it up. You're gonna wait. You're gonna wait. Finally, what'd you do? Well, Okay, we printed these bars over the zero line, so we have an uptrend now. There's another filter we use to tell us conclusively. And diagonal trend line break, up we go. Boom. Okay. Wash, rinse, repeat, people. Or a lot of people like having it complicated because they can always find something to blame. When you make something so simple, gosh, then you got to look in the mirror and actually blame yourself for not following your rules. There's all kind of profit considerations to choose from, including profit targets. You decide the target. When markets are tight, I use the profit target. Absolutely. 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 Maybe it'll be 8 ticks on gold. Maybe it'll be 8 ticks on, we were doing 15 and 30 on the NQ. Okay. If you find the markets are moving like they have been in 2018, wow, you want to use runners. One day I did gold, and after taking 8 tick profit, the darn thing came back, take you out at break even. It did that 4 times in a row. So maybe I should have used all in, all out, 8, or used 8 and then used the runner, right? And not moved it to break even so quickly. So I believe exits are the most difficult. If you want to use CCI, when you see the CCI turn from 150 towards 0, that's your first shot across the bow saying, hey, momentum might be changing. Be careful. If it crosses the 100 line, that's minor support and resistance, or crosses minus 100 towards 0, then you're being told, hey, get out. You can always get back in. Or if price touches a channel line, okay, then you probably want to say, okay, I'm in this for the trade. It looks like it'll be a nice trade. If it makes it to the channel line, I'm happy. What I've shown you will work across any instrument, any chart time frame. If an action repeats, we can trade it. Day trading, use activity-based charts. What does that mean? It means volume or Renko or what else is there? Range bars. I mean, anything except just looking at the watch and saying, well, hey, 5 minutes have gone by. What's everybody doing? I'll take a trade now. And the problem with that is in a moving market, you can have a huge 5-minute bar. You get in because it meets your rules, and then the price retrace half that bar and knock you out. Okay? I believe that the time bars are great for really slow price action. If you must use a time bar, try a 1 minute. Okay? All right. Create no-go rules. I'm not interested if the range is $200, say to $225, $240, $250. I'm not interested. I'm just not interested. You will get chopped up. So let price resolve the chop. I'm running out of my time here now, and I wanted to talk a little bit longer. Let me take questions if you have any questions. Remember, in day trading, it is no different than playing cards at the casino. Your strategy at the casino, playing cards, is how long can you sit there until your strategy proves itself. Okay? So the day trading is never the result about an individual trade or the result of an individual day of trading. Okay? It's never about the results of a week of day trading. It's over time. How is your system looking? So when you test this, you test your system, you must consider a larger time span. Consider maybe 3-month minimum look back. I got an email today from this what this World Cup deal is for trading. And all these guys, it looks like, the top 3, took over a 20% drawdown in their account. Now they're position trading. But one of them's up like 92%. Okay? He was willing to lose 24% of his account. The bottom line is over time, the system proved itself. And that's so important. It's also why you cannot expect to open an account with $2,500 and succeed in this business unless you have really, really, really perfected your simulated trading. Okay, any questions? Any questions? Any questions? Any questions? This is a numbers game. Let me see if I can find the questions. Let's see.
A couple things, Martin.
Yep.
There were a couple things that were asked. One of the questions that came through earlier was about how to apply, or can this idea be applied to a ZB, the 30-year bond?
Absolutely. Now on the bonds, I'll use a 3 range bar chart because a lot of times they move slow. Okay. One tick is $31.25, right? So, but yeah, it will absolutely work on bonds. It will absolutely work on bonds. Whether you're going to be position trading or you're going to be day trading, absolutely it will work on bonds. What's the main requirement? It's got to be moving. Now, in Rooster Call, I've been telling people 142.19 is our line. And over again, we see price go to 142.19 and pop right back up. This means the machines are using that line. And if we break down, then the day trader is looking to see if we come back over 142.19 because chances are they're going to run it back up. They've done that this week and last week. So yeah, these lines are very important, but you can, all of this works on the bonds, absolutely. And Forex. Any other question?
Yeah, there was one more question that I think everybody would probably benefit from a little bit, and that was, could you just do a quick run through again of the trend line break? Just that idea, maybe bring one of those charts back up.
Bring forth.
Just give people a...
Okay.
Right.
All right, let's talk about this. Let's go in a deep dive, okay? Let me get my tool. What are we being told here? Suddenly, I've crossed the zero line. So my bias now, according to CCI, is that price should be moving up. That's a ship's watch. I've got to go on deck in a few minutes. Here's a diagonal trend line from 150 down. Now, there's no bump here, but that's fine. I just run it down. If there's a bump, I just feel better about it. What's a bump? Here's a bump. So, draw the line. We come through it. Let the price bar print. Because what will happen is this bar looks like, okay, it's triggering, and people get aggressive and they want to enter, and the next thing you know, they're entering before the price bar prints, and we go down. And then the next thing you know, it goes down. Then it goes down, and it goes down. So let the price bar print. Let's take a look at this one. Am I above 150? Yes. I touch it here. So it's like the momentum force came up and just couldn't do it and just fell back. Okay? So, in other words, if the CCI is going down, I'm expecting prices going down. But suddenly, over here, I just extended. Now we're getting a signal to go long. Now, let's be honest here. We could have very easily gone into a long sideway deal, right? We know that. We know that. We could have gone in and just cussed. Say, darn it. But we had follow through. Okay, we had follow through. My point is, don't get upset if the first time you go to use this, it does this to you. Diagonal trend line break said take the trade. So, okay, we take the trade. We're going to put that stop either here or the one prior to it. Whoever is lower, they look about the same. And that's it. And now you just, you're saying, okay, well, it's crude. Martin Rimes said they expect to move at the 7 a.m. hour. Hope it's right. Did we get it? Yeah. Let's look over here. Am I from at least 150? Yes, that's the requirement. Check. Draw it down. And if we break through, okay, well, we broke through. I don't have this one marked. Let's do this. Something like that, I think. So the stop's going to go whoever's lower. Let's say it was that one. And it goes up a little bit, and it didn't give you that much. Each one of these is a $100 range. It didn't give you that much, but it worked. And then you can start seeing, I mean, it's easy to see it now. You kind of went sideways. But, you know, if you broke it, if you took a little loss there, or you took your $100 there, or whatever it was, $100 is not a bad deal. And then you're just waiting, and you don't get another signal. Well, here's one. There's my bump right here, right? And I'm drawing it from minus 150. So this says I should be going down. Now, if this is a CCI trend up, then I'm doing a counter trend trade, right? So let's see. Stop would be, I don't know. I guess the stop is either this one or this one. I can't really tell it. And we did go down. But it also went sideways, right? And that's always the devil. All you can do is, this, if you didn't get stopped out here, it made at least $100. Here's a diagonal trendline break here that shows up. And this turns out to be the one that you write home about. Right? And then the gift just keeps on giving. You're in the trade, and suddenly you see that you're long, and now we start printing above the zero line. You can't believe it. And now a diagonal trendline break comes. We have no bump. I'm just drawing it from 150 all the way down. I just, just draw it down. And we broke. So I guess right here's a buy signal, right? I'll try to do that straight. There's your stop. You're still long here, one, because you like to use a runner. You can't believe it. And it goes on up. If you didn't use a runner, fine. This is a great trade here. Comes down. If you use a runner, you're still in the trade, right? We get another signal here. Now, this is a deal where it's not 150, but it's so close. So if someone said, well, hey, I took this trade here, who am I to argue, right? It's so close. It's almost like splitting hairs. I just am firm about 150 for people that are doing this for the first time. If you can just hold off and do it from 150 or higher, the follow-through seems to be much greater. That's what my testing found. Did that help? Did that help? Hello?
Yeah, Martin, I'm here. I'm just reading the questions. Yeah, I think that was as good an explanation as anyone can expect, for sure. Okay, so there's a couple other questions that I can somewhat handle. Michael was asking if it could be automated and that whole thing. I mean, we've talked about that a little bit, but there's definitely some subjectivity, to this, I believe. And while if you could define rules, this is certainly something you could automate in Sierra, but you would definitely lose the, that intuitive touch for sure. By doing that,
you can definitely have it in an automated environment. Absolutely.
Right.
Absolutely.
Right. Okay. Well, there's a couple other things that came through that that I think you can answer pretty quickly. What size range bars do you use for the S&P and the NASDAQ?
Okay. For the ES, I'm going to use a 10 range bar chart. I've got clients that write me and say, hey, I decided to use the 8. I'm liking the 8. And that's great. Great. I want you to use what speaks to you. But I use the 10 range bar. That means in a range bar chart, that means it will travel at least the range of 10 ticks. It might go down 7 and up 3, or up 3 and then down. As long as it does 10, then the bar prints. If it's super, let's say that it's one of those days and it's a tighter range, like August, and if I can see on a smaller time frame that we are getting good signals and not fake outs, I will lower it. But 99% of the time, at least 95, I'm using the 10 range bar on the ES. Now, it's a good question you ask about the NQ, because the NQ is a lot greater movement in there and larger. So I'm going to use a 20 range bar chart. A 20 range bar chart. And what that does is it helps to, I don't get chopped up with the fast action, you know. You can go back in hindsight and say, well, gosh, I could have used a 10 range bar. But that 10 range bar so many times can just whip around, take you out, and then keep going. So I just used the 20 range bar on the NQ. Let's talk about the YM. I use the 15 range bar on the YM. Let's talk about crude. I'm going to use the 10, but I'm watching the 20. All right? I'm using the 10 for tactical entry, but I'm watching the 20 for just the bigger perspective of momentum. All of this, Patrick, I go deep dive in, total intensive, okay, in the course, and it's so much that we're doing, tying it all together. I see there's a question about gold. Gold is a 10 range bar. Next. No, Larry, it doesn't have to be, and good to see you, it does not have to be range bars. Okay, I traded the 512 tick chart for years on crude. The only reason I use the range bars is because I personally like the uniformity. And it also means that when I use my protective stop the way I use it, it's always going to be around the same amount of money. So that's the only reason I like it. But for years I used the 512 tick chart. Volume. I think that I had a customer using 11,000 volume on the ES. On the bond market, 250. I think it was a 250 tick chart and a 500 tick chart. Heating oil and gasoline. I've never day traded heating oil. And the gasoline only position trade. So I really don't have a feel for that. I would say start it out at 10 and see how it goes. Okay, and what you're looking for is, you see these, like this chart here, the 10 range bar crude I've got showing. Do you see how it's clean? It's not all jumbled up. It's not, suddenly it's above zero, suddenly it's below. It's just, it spends time above the zero line, time below. It just, and when you see a signal, you see that there's follow through. That's how you decide what to use. I mean, I've looked at the 1 minute chart, and there's nothing wrong with the 1 minute chart either. Wrinkle bars are kind of interesting. I've done some testing on the Rinko. I honestly can't remember what my settings were. It was nothing fancy. It was just, I think, a standard. I just can't remember. But I thought the Rinkos were kind of interesting. Roger, if you write me, I might try to remember what that was.
Martin, I have to wrap us up here pretty soon. Are you through with most of the questions?
I've got to cook dinner for my niece tonight. Yes, I'm
All right. Well, excellent. I think that I would definitely, another thing to note about Martin, everybody, is that he is extraordinary with email, okay? I think I'm pretty quick with email most days. Martin is very accessible. If you just send him an email, if we missed anything that you want to have covered, if you want to ask him questions about his classes, just email him, martin@hitthemarktrading.com. He has an auto reply. You'll get a reply immediately, letting you know that he got the message, and then he's really good with replies. So don't be afraid to contact Martin. And I just always love these presentations because there's something actionable right away that everybody can take away from it. And a lot of times you don't get that in this, sort of condensed environment. So that's good stuff, Martin. Thanks for making the time to do it.
Great, and I encourage everyone, if this has spoken to you in the smallest amount of way, it is worth the course investing 6 hours. It'll be minimum 6 hours. The information is really, really good. All right, and thank you for that, Lockie. Patrick, thanks for the day. Thanks for everyone attending.
Yeah, definitely. I just put the links to both the Rooster Call and the store if somebody wants to buy the class in the chat box for everybody. So if everybody, take a look at that, definitely check out the Rooster Call at the absolute very least. It's a great way to start the day. I look at it every day. It's good stuff. So thank you again, Martin, for doing that. Everybody, thanks for listening. We appreciate that. If you are looking for a recording of today's event, we'll have it up on our YouTube page probably within a day or so. Just let your rep know that you're looking for it. We'll make sure to get you the link if you don't have it. And we'll see you next time. All right. So thanks again, Martin, for doing that. I'm going to take the screen back here while I read it, a disclaimer one more time, and then we'll close the room up. We'll have this up on YouTube probably within a day or so. And please feel free to enjoy that. Contact Martin and give us some feedback. Let us know how it goes. We certainly appreciate that. All right. Thanks, Martin. Thanks, everybody, for coming.
Thank you.
All right, folks. Trading futures, options on futures, and retail off-exchange foreign currency transactions involves substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. All right, folks. Thanks again. Good night.